The next session is clearly on euro clearing, the open race, whether Frankfurt will be the city who might gain from Brexit or whether it's another city. I try to be a bit more interactive and also to ask you, the audience, depending on where we just stand in our discussion. So please be prepared to vote on your device. Thank you. So thanks very much for joining. I think it was my phone doing that sound. Okay, I'm delighted that you're here next to me. I'd like to start with a short presentation of who is actually sitting here on that panel with me. On the very far left or right from your view is Erik Müller, CEO of Eurex Clearing. Erik has more than 20 years experience in capital market and is a member of the executive board of Eurex Clearing since April 2013. Then it's Fabrizio Planta, head of the markets department with ESMA. He'll actually speak to us about the future of regulation and what might the updated EMIR version might mean for the whole process and for CCPs, the clearing houses. Then we have Karin Dohm, Global Head of Government and Regulatory Affairs, also more than 20 years experience in financial markets, since 2011 with Deutsche Bank and before with Deloitte, right? Christoph Hock, last but not least, Head of Multi-Asset Trading with Union Investment, also more than 20 years experience in the markets with having worked in various international roles with Barclays, JP Morgan, and others. Well, thank you very much for joining me here. The big question is, of course, very interesting for Frankfurt, whether Frankfurt will win from a potential relocation of euro clearing to the continent. Perhaps we start off with Fabrizio on that question. Do you think we'll get that location policy?
So before going to the location policy, I think that there is a step, and so let me take it back from the actual question for the panel, what Brexit means for clearing. And under the current regulation that is EMIR, what it means is it means that if UK CCPs are not recognized, then European clearing members will no longer be able to access those CCPs. This CCP will no longer be able to clear for European clearing members, and even if these European clearing members would go via other clearing members, via clients or via subsidiaries, they might face higher capital requirements. So this is the situation now. Of course, already now the recognition of third country CCP is envisaged through equivalence and recognition by ESMA, but as Mr. Mercer reminded before, now it is very much a monitoring exercise based on third country rules. And this is something that ESMA has already stressed in 2015, so well before Brexit, that it was in our view, something to be addressed in the revision of EMIR. And to look more at what other jurisdictions do, which is for systemically important market infrastructures to not fully rely on the third country rules and the third country supervision, but actually imposing our own rules and the supervision of European. In this case, it would be ESMA under the Commission proposal.
It's only 10 months away. Is there not a lot of time pressure now to come up with like some viable scenario in 10 months' time?
So the solution, in our view, is EMIR 2.2. And we need to make sure that we have the proper way to arrive to implement the EMIR 2.2, because as I explained a few minutes ago, EMIR is not fit for dealing with the recognition of UK CCPs. And that's why the Commission 1 year ago came with this proposal, that it is still under negotiation, but that it is essential to make sure that we as Europe have the proper tool to deal with UK CCP. And proper tools means a number of steps. So under the proposal there are Tier 1 CCPs, so non-systemic, Tier 2 CCPs that are then subject to rules and supervision by Europe, and then the so-called Tier 3 where it is envisaged a location policy, which would then not allow the third country CCP to continue to offer these products, but will need to relocate this business. It is there are different tiers. We believe that we need to use these tools in a proportionate manner. There is a political process also behind the location policy, with ESMA and the Commission to make a proposal, then ESMA and the ECB to make a proposal, then the Commission to endorse. So before arriving there, I believe that there are other steps and other tools that we first need to use before saying that they are not sufficient. Because we know, and also Mr. Mersch just reminded, that there are also effects in terms of market fragmentation, etc., if we go in that direction.
Perhaps a question to you, Erik. What are you hearing from clients and from people you're talking to? Is there a certain willingness or a certain pressure, also contingency planning perhaps, that people would like to clear rather in Europe than in a country which is going to leave?
Yeah, thank you for that question. I think, as a CEO of a CCP, I can subscribe to a lot of things that Yves Mersch said and that Fabrizio said on the importance of these organizations. And of course, Brexit throws open a lot of questions now on supervisory oversight, who is responsible and who is the ultimate hand on the steering wheel, shall there be a crisis. I don't think these questions are answered. I agree with you that time is short. The end of March 19 is not far away. I do hope that a good legislation like EMIR or the EMIR amendment now can pass in the foreseeable time horizon, but we don't know that. So our objective is to talk to the clients, find out what their needs are, and the needs that we hear is that today obviously all eggs are essentially in one basket in London, and that seems like a very risky setup given the circumstance. So what we came up with at Deutsche Börse is a market-led alternative for these market participants to build up a second liquidity pool. And the way we have done this is by offering essentially for these banks to become partners in an equity type fashion. So they get a claim on the cash flows, i.e. a share in the profits of whatever Eurex clearing will make in interest rate swap clearing, plus they get governance rights, and to that effect the take-up has been very promising. We came from less than 1% market share 12 months ago to over 6% market share now and rising, and the governance will be adjusted in end of June to reflect and welcome 5 market participants who have been very active in the initial phase since January.
Can I ask you, Karin, Deutsche Bank is a global player, of course, with a lot of clearing most likely taking place in the UK. What would you do in the future, or what would your institution do in the future?
Yeah, thanks for asking. And probably some of what I would like to state is very much mirroring what was just said by the others. So obviously, we have two main considerations. On the one side, as also Fabrizio said, you have the immediate risk, and you said it already, it's not far away, of UK CCP losing equivalent status and thus creating, of course, for any bank that is in the EU homed and has any clearing activity there, the immediate risk of substantial changes in the RWA, so capital increase requirements. And I think that's something where regulators and supervisors need to look into when it comes to just thinking about the current contracts, the existing volumes and portfolios, so to say, the things that are currently in our books. And I would strongly differentiate that from the debate, what is happening on day two, what do we do going forward, what does the landscape look like around clearing within the EU or also with CCPs outside of the EU in the future. And as Erik said, of course we welcome competition, of course we welcome new offers, and are very, so to say, diligently looking into the market to make sure we get the best pricing also for our clients. Because of course this is not only clearing of our own activities, but it's clearing of banking activities. So I think our main aspect there is we are not welcoming a forced location policy, but we're very much welcoming a good, healthy competition, because that at the end of the day offers additional possibilities for our clients as well as for us. Forced location, we see similarly to what Yves Mersch said, we see there a risk of over-fragmentation and at the end of the day a risk to the pricing models. If liquidity pools become fragmented or not accessible by everybody in the same manner. And of course, just the last item here before I pass on, of course, EMIR is something that affects EU banks. No? Take the US banks, take the Japanese banks, they are not affected if we have a change in the EMIR. Thus, they could, for example, keep on doing their euro clearing in London independent of those changes. And that would create the risk of an unlevel playing field from our point of view.
Yeah. Christoph, if you had the choice, would you rather clear in Europe or in the UK going forward under Brexit?
For us, Annette, competition is really the key factor in this context. So when we're looking at all the regulatory initiatives we've had over the last 10, 15 years on the trading landscape, look at MiFID I back in 2007, 2008. We just had very freshly the implementation of MiFID II in January 2018. One of the key objectives from a regulatory perspective was, on the one hand, guaranteeing financial stability, and on the other hand, creating competition. And in pretty much all asset classes for the last 10 years, we've seen a significant increase in terms of competition. For instance, take cash equities. About 10, 15 years ago, Vodafone was traded 95% of the volume on London Stock Exchange. A Daimler-Benz was traded 95% of the volume on Deutsche Börse, on Xetra. Now these days, you probably have something like 60 to 70% market share with the primary exchanges. You've had a fragmentation, agreed, which caused a bigger complexity, but our ultimate goal is to deliver, as an asset manager, is to deliver best-in-class service to our investors and to lower transaction costs for the benefit of our investors. And that's why we need, looking at market microstructure, we clearly need to have competition. And in the clearing space, I guess it's a fair assessment that for the last years we haven't had competition. You've had monopoly structures, taken LCH. They've had something like, Mr. Mersch was also citing the numbers, we've had something like 95% of interest rate derivatives cleared on LCH. And obviously monopoly structures are not beneficial for lowering cost of trading. And also when looking at innovation, that's completely left aside. And that's why we highly appreciate the partnership program Deutsche Börse Eurex offered to the market, which caused prices to come down, bid offer spreads to tighten. And our assessment is that with this new offering, we are able to lower also our cost of trading, and in this context, cost of clearing. And therefore, coming back to your original answer, would we prefer to have a strong second clearing hub here on the continent, i.e. with Eurex? Clear answer is yes.
Okay, now it's the moment I would like to ask you, the audience. It's question number 3 we'd like to start with. A very easy question, but I think the answer is most interesting. The question is, where will the Euro clearing party take place in the future? Do you see it already? No. So the question is, you should see it on your phones. It's number 3. Where will the Euro clearing party take place after Brexit? It's only 10 months away. In London, where else? Where it is now? To Frankfurt is the natural choice. 3, neither of both. Paris will be the big winner. Here. Okay. Okay, it's like live as we speak or as we listen. So we wait a little bit longer. It looks like that the tendency is quite clear. There's a clear bias towards Frankfurt. It's yeah. Okay, I think it's fair to say that the results, at least here from that audience, is that people or you guys are expecting that the bulk of the trading volume might actually migrate to Frankfurt. Going forward, if the UK is leaving or after the UK has left the European Union, in which kind of way, we also don't know yet. So I would say that's it. Now we stand with total votes 70. We have a big majority for Frankfurt. We'll see that going forward. I think it won't be something which is, if it's going to happen in a very fast manner. Perhaps, Fabrizio, you could enlighten us a bit about how difficult it could be to migrate actually parts of Euro trading from Brexit, or how Brexit might, or how Euro clearing might look like after Brexit.
As I said, although the audience seems to have a clear picture there, the objective of the legislation of EMIR 2.2 was not to move the clearing the day after Brexit, but to ensure that we have the proper tool to regulate and supervise UK CCPs. And only if those tools would be insufficient, then there is also the possibility, through a political process, taking into account all the effects, etc., to force relocation. That, as one representative of the panel the banks are saying the same thing, and we know, because I take the point of the competition. We are all in favor of competition, and you know that MiFID pushed very much on the competition on the trading side, but having different pools of liquidity where to trade is not exactly the same thing as having your collateral split in different pools and be able to trade only with certain counterparties. Having certainly there is a very interesting proposition there, and other in the market to see where to relocate the business margining effects due to interest rate. The big advantage currently, looking just from a market perspective, that LCH has now is the cross-currency advantage, and the fact that it's an international pool of liquidity. Also, Eurex is a very important international, and they offer, and this offer that they just presented is certainly very interesting. We'll see how the market takes it. They, as I said, they have the advantage of the cross-interest rate perspective, but I just wanted to highlight that it's not the same thing trading in different trading venues or clearing in different CCPs.
Okay, you have a reply to the...
Yeah, maybe to share some insights of the very in-depth research we've done on this topic. You might remember it was about a year ago when Mr. Rollet, at this point of time the CEO of London Stock Exchange and also in charge of LCH, when he came in the FT with some headline numbers saying that whenever we have a relocation of clearing here into the EU 27, cost of, I guess the number was around $100 billion he was mentioning. Maybe I'm wrong in the currency, but I think it wasn't pounds, it was dollars. That this burden would come to the market. And this actually, I mentioned, we as an asset manager, we are really focused on cost in this context, and that's why we did an analysis to see whether it's right that we will have additional cost with the relocation. And the outcome was that in a kind of base case scenario, we don't have additional cost, but we don't have benefits on the other hand. In the very best case, we will have something like 30% cost saving. And in this context, I would like to refer to the innovation component I've mentioned prior to when cracking up these kind of monopoly structures. Looking at the Eurex offering currently, collateral is a key component of the cost embedded to clearing. Looking at the offering of LCH, it's pretty much cash and highly rated bonds we can deliver as collateral. With Eurex, we have the flexibility to have a pool of nearly 16,000 various underlyings we can deliver as collateral, and taking a haircut into account, Eurex accepts also equities as a collateral. The other key component of the cost embedded with clearing is margining. And looking at our portfolio structure, it's less beneficial for us, the offering of LCH, which has a cross-currency netting in margining across OTC products. For us, a big benefit comes from the fact that Eurex, and again here in the context of innovation, that Eurex offers a margining of listed products on the one hand and OTC products on the other hand, which isn't possible at LCH. So for instance, you can take Bund futures as a listed product, and you can offset the margining against OTC rates products. And on top, which also an LCH doesn't offer, you have the repo component where you have this cross-asset margining, which is possible at Eurex, and that's actually one of the key points why we as Union Investment already started to clear interest rate swaps, not only on LCH anymore, but we are currently in the process of setting up the procedure that we are able just in time to shift products to Eurex clearing here to the continent. And again, it will be in the benefit of our investors.
Karin, you had a comment as well, Karin?
Yeah, I wanted to add two things to the debate. First, I think what needs to be taken into account, I think, is euro clearing that currently happens in the UK is to roughly 25% done by EU banks. So the majority of what is happening there is done by non-EU banks, once again, which are not impacted by any changes in the EMIR to that degree. So I think we need to really take into account that there is, to the earlier question of the vote, will it be Frankfurt or Paris? I would think, isn't it then a question between New York, London, or perhaps Singapore? And I think that's something that we need to be, especially from a European perspective and of what we want for our clients, for example, large corporates, small corporates, medium-sized corporations here in Europe. We need to be very careful to not cut some lines towards instruments that are currently available at a certain price. And the other thing I think we should take into account is we might differentiate in the debate also about products. Even Mersch already mentioned, repo is a different animal, so to say, than potentially a classical interest rate swap. And that's also something which probably in the debate between ESMA and ECB can be of interest to say, isn't there also a different view onto the approaches towards different instruments, which would totally make sense from our point of view.
But wouldn't it just be possible to split the market? It's a huge market. The volumes are really mind-boggling. If you look at them, it's just more than 1,000 billion euro per day. We're not talking a year or a month. So it's a gigantic market. So why not splitting it?
Yeah, so I think in reaction maybe to some of the comments from Karin. So first of all, our liquidity pool here at Eurex Clearing in Frankfurt is fully international. We have exactly the same international market participants on the sell side, i.e. The large banks than our competitor would have in London. That's point number one. Point number two, assume that this is a very dealer-led market. So there may be 10, 15 large banks in the world who quote prices to the buy side. So two guys like Union Investments or BlackRock, Fidelity, etc. So I think the key to focus on is what's the quality of these prices and how do they differ between London and Frankfurt. And I think one big achievement of the program so far is that we now have more than 10 banks who quote exactly the same spread, bid-ask spread, so the same price for a Frankfurt executed swap versus a London executed swap. So that really for the first time offers that choice to the so-called buy side, so to the investment funds, to really have an alternative when choosing their clearing venue. So I think that's critical. I don't see the risk that there is a domestic pool here, and I also think the 25% number in terms of EU banks' involvement, that's kind of the back mirror. If you look ahead, what's happening is all the banks, including the large US banks, are implementing their contingency plans, and we have admitted very recently the first of these large banks with a second EU entity, i.e. they will replicate what they will have in London today, entity-wise, on the continent.
Do you think it's not too costly to have like a double structure for these banks? Banks are under so much cost pressure these days, so isn't it more straightforward just to go for one solution.
That's why we sorry, that's why we have offered them to participate in the economic success of the offering. Of course, duplicate structures create cost, but we come from a very efficient setup where all the banks have put all their balance sheet and all their people and all their activity into one place. Now, with the elimination of the single passport, I think that structure obviously can't continue, so there needs to be a new equilibrium of how this all can work in a post-Brexit world. And I think that's what the industry is concerned with. And yes, there will be additional cost overall, but that's due to the choice the UK has made to exit the EU. Those additional costs will not occur in the field of euro clearing.
So Karin,
just a short addition to that, and I think totally to that point. Of course, that's one of the reasons why we think we welcome, and I can only repeat that, we really welcome this offer of Eurex. We're also very positive towards that. We welcome additional possibilities, and we welcome the possibility to choose from a variety of offers. But a forced location, independent of which direction, is always something that we wouldn't think adds value to neither our offer and our solutions for the clients, nor to our own processes. And if I just may add here one item, and that is of course about the cost angle. It's not only those costs that are implied by potential changes around the CCP. Brexit, right, as everybody here probably will subscribe, is an additional cost in itself. So any part of those additional costs that we can avoid while still getting to the objective of sound financial markets, I think is warmly welcome.
Yeah, but
just to clarify that we are very much supportive of competition and open markets, and that's why I think that we need to look careful at the question of the location if we want to maintain Europe as an open market. And I'm not defending anyone here, but the stability of Europe, and that's why if we take that measure, it will be because there are concern on financial stability, and that there are no other tools available, not just to decide to split the market in a particular manner, because by doing that you might simply risk to lose it. And that doesn't necessarily, I mean, it's not that we as regulators can decide that we take part of the market and we move there, because the market is done by the market participants. So we needed to create the necessary incentives for the market participants to operate in a fair, proper marketplace to avoid any regulatory arbitrage and so on and so forth. But this measure, it is envisaged really as a kind of a last resort, and for if there are monetary policy or financial stability concern, not as an immediate consequence of Brexit.
Yeah, before you can enjoy your lunch break, I would like to do one last little vote on what you think. It's question number 2. Would it be possible, in your view, to split the market for euro-denominated derivatives? I think there are competing views on that topic. Some are thinking that's better to keep it all together, and others are thinking a fragmentation and i.e. competition is actually helping the pricing. So we see one answer is yes, that would lead to more choice and competition. No, a fragmented market causes more cost, and 3 is not sure. So here we go. It seems that the free market theorists are having the majority here. Yeah. Okay, all in all, I think we are probably approaching some 60 votes, perhaps, for 54. It looks like that the clear majority is that there is a clear desire to have also more competition and more choice in that market, and that there should be a possibility to split it. As I was saying, we're only 10 months away from Brexit, and perhaps like shortly, just to sum the whole discussion up, what are your main expectations? What is going to happen after the UK leaves the Eurozone, Europe, I should say, to the clearing process? Christoph?
For us it's key that we work hard on having a market infrastructure which allows us, in terms of execution quality, to deliver at least a similar service to our clients, to our investors, as we are doing it right now. So definitely no additional cost for our investors. In the best case, benefits, additional benefits for them. That's what we are working hard on.
Okay, Karin?
Same here. I think for us, independent of clearing or the general topic of Brexit, the most important aim is to make sure that we give our clients a seamless transition as well, not only for us operational, but more than anything else for the clients. And I guess, therefore, you phrase it quite nicely, 10 months. Is it 10 months? Is there a transition period? If so, what type? I think that's then the next big question. Already.
Yeah. Fabrizio, will there be a transition period?
Currently, it is not envisaged in the regulation. It's true that the legislative framework was envisaged differently. There are discussions on general transitions. Let's wait and see how all this ends. Certainly, the fact that the European Commission came with this proposal more than 1 year ago and reform the framework was to avoid to arrive to a potential cliff edge effect. So I don't think that that is the intention of the European legislator to arrive there, and so we are certainly focusing our attention to prevent it.
Okay, thank you.
Yeah, so our role as a market infrastructure is to help in the transmission process between regulation and then market. So, as I said, we make an offer, we put an offer forward to the market, and we will try to help our clients navigate the uncertainties. And if in the end, and that would be my expectation, this leads to a situation where you have two instead of just one, I think it's the better market structure for everyone involved.
Well, thank you very much for your time and the discussion. So I think we've all understood that it's not very easy to make a call on whether Frankfurt will actually gain from the UK leaving the European Union when it comes to euro clearing, whether the market decides that Frankfurt is the place to do the business going forward. And there is still a lot of work to be done on all fronts, I guess, in the next 10 months. But before all that work has to be done, I leave you now to your lunch break, which will last, I think, for the next 45 to 1 hour. Thank you very much for your patience.